All right, teammates, we're going to start chapter 2, which is talking about type of life insurance. So we're gonna start with that section. So we're gonna get it moving. So this call is also being recorded. Then I'll post it on the MMC channel, and then you guys can go back and review it. But this will not help you if you really not reading the book. This is not going to help you. So, but if you read the chapter already, so most likely this is going to help you a little bit. But if you did not read it, so I don't know how you're gonna be able to pass the exam, because there's an amount of reading that you have to do in order for you to pass this class. Because the exam is not hard, but they try to trick you. Like I say, if they trick you enough, you get to fail the exam, then you have to pay the money again. So that's the reason I do the best that I can to see if I can help you guys a little bit before you go take your exam. But at the same time, if you're not focused as well, it's not gonna help you either, because you got to be willing to listen and take notes and participate as well. So we're gonna talk about the type of life insurance policies, and also hopefully we're gonna get a chance to cover the annuity section as well, because life insurance, it's in case somebody die right now and they'll get a chunk of money. But annuity, it's in case somebody live too long than expected. It's not like people really live too long, but what we're saying is that sometimes somebody might, they might live past, 80, 90 years old, but they didn't expect they were going to live for that long, and they did not save enough money to take care of their retirement. So that's why we say in case the person living too long. Okay. So now there is actually two different. First, let me just explain the term. Term insurance is something, just like I said, term means temporarily, something that's there for a period of time. That means it's not there permanent, it's for a period of time, such as it can be there for 1 year, it can be there for 5 years, it can be there for like 15 years, 20 years, 25 years, 30 years, even 35 years. So that's what a term means. It's there for a period of time. So now you're going to see, say, term insurance is also what we call pure protection. Okay. So that's mean it's pure insurance. It lasts for specific term. And I just explained that. Most insurance, okay, most insurance for the least premium. What does that mean? That's when you have more coverage for less money. So that's mean that this type of policies, this type of insurance, it's less expensive. So it's not that expensive. Okay. Now, what I want you to focus is on, there is three types of term. Okay, there's three types of term insurance. So I want you to get that in your notes. The first term we're going to talk about is what we call level term. Okay, that's a level term. The second one is a decreasing term. Also what we call an increasing term. Now, at the same time, teammates, what I can tell you, there is what we call return of premium rider. That's a term, it's about term as well, and annual renewable term. So now, but what we're talking about here, we don't have to focus too much on those two, but there's three main type of what we call term insurance: level term, decreasing term, increasing term. Now, what you need to ask yourself is this: if there is those three different type of term insurance, why or where or how can I use them? That's the question. Because if they have them, there is a reason for them. So now let's talk about the level term. When something level, okay, this is the word. Level mean straight. Level mean it doesn't change. But now if somebody have a level term, what doesn't change, because I know something is level, but what's level? There's something that do not change. And one thing I want you to know, term insurance do not have cash value. So any of those things I'm about to explain to you here, at the minute you that term insurance, they do not have a cash value. So that's when you cannot borrow money from that policy. Sure you get that. So now, level term coverage stay the same for the specified period. For example, let's say somebody buy a term for 20 years. That means the coverage, if it is for 150,000 and they paying $100 a month, that's when that term gonna stay there for 20 years. Level is not gonna change. The face amount will not goes up or down. It's gonna remain the same for the whole 20 years. So it pays a benefit only if the insured die during the term. So it's only gonna pay if you die during the 20 years. But if you don't die after the 20 years, you're not going to get any money. That's why I call this is a term insurance, is pure protection. No cash value. So level term, what's level? The face amount, it's level. The coverage is level. All right. Let's go to the next one. So now, before I go to the next one, why would somebody get a level term? Well, maybe somebody say, listen, I don't want this. I don't want I want everything to stay the same. I don't want no change. I don't want to see the premium go up. I don't want to see the face amount go down or up. I want everything remain the same, constant. So a level term would be good for that person. What about a decreasing term? Okay, decreasing term. That means it is a term insurance. That means there is no cash value, but there is something that decreasing on it. Then we need to know what that thing is. So now, when we talk about that, it's not the premium. The premium do not go down. Only the face amount decrease. Think of a mortgage. Let's say that a mortgage. When somebody buy a mortgage, as you're making payment, the principal goes down. Now, as the principal goes down, okay, as you got the principal go down, every time you make every time you make the payment, the principal goes down. So that's what happened with the face amount of that policy. So now, why would somebody buy a decreasing term? It's to protect a mortgage or debt. So coverage gradually decreases at a predetermined time. So that's mean the coverage goes down as a predetermined time. So that's in the face amount. If that person buy a decreasing term for at least $100,000, that's mean it's going to go down. The face amount gonna goes down, but the premium gonna remain the same. Just like in the level term, the premium do not change. The premium not gonna change. So whatever money you're gonna pay in the monthly basis is not going to change. Best use when you need protection decline from year to year. What decline year to year? A mortgage do that. Maybe a credit card and credit insurance do that. Let's say that if you go to a bank, or maybe you go to a dealership, you buy a car, and they put an insurance, they put an insurance on you in case you die. That's called a credit insurance. As you keep paying that car, you're making the payment, so you don't owe that much money. So that's when the debt going down. So that's why you need a decreasing term. So now, when you're in a test question and you see they're talking about debt, maybe somebody going to send their kids to college and they borrow some money, okay? What insurance would be suitable for that person? A decreasing term, because when they're going to college with that student loan, that's when it's debt. So they want to make sure they use that as they keep paying the student loan, and they protect that, with an insurance policy, what we call a decreasing term. So just remember what's happened there, okay? Now let's talk about let's see, that's return of premium wide. This is a return of premium term. So this estimate is like it's kind of like a term insurance that, just like you said, they're gonna return the premium to the client or to the policy owner. But let's read about it, see what happened. The insurer, which is the insurance company, return premium paid at the end of the term if no death benefit has been paid. You get that? That's the only way you're gonna get that premium. So if you don't die, they're gonna return you the money that you pay. They're gonna give you the fixed amount, but they're going to return the premium that you pay at the end of the term. Let's say you have a return of premium right there for 20 years. And then after you've been making those payments, so in that 20 years, if you don't die, they didn't pay no death benefits. So they're gonna return those premium back. All right. So may not return the premium in the first few years of the policy. So that's the rule they put. So even though we say we're gonna return that to you, but we're telling you in the first few years, few mean at least 5 years, if you cancel that, we're gonna return nothing. Beneficiaries may receive the death benefits only. So now, see what they play the game here. It's kind of the same like what their whole life is doing with the cash value. So they're telling you, we're gonna return the premium, but if you die, we ain't gonna return the premium. We're only gonna get the death benefits only. But if you don't die, at least you gotta get something, so they're gonna return you the premium. But you gotta be in that policy for a few years. After, if you're not there a few years, I don't know. But you gotta read. You have to read. Okay, you have to be able to read what the contract says, because whatever the agent telling you, it doesn't matter. It's what the contract says that's important. Okay. Now, annual renewable term. That's like, some people might think, well, this could be a term insurance, but it is. But that's an insurance that, just like you said, it's renewable. It's able to renew. How often? Every year. Every year. So now, let's talk about this for a second. If you have a policy that needs to be renewed every single year, what happened to somebody age every year? See my finger? It go up. If it goes up, that's when your age goes up, the policy gonna goes up. So every time you renew, most likely you have to pay more money. Now, this is usually they use annually renewable term insurance for a group policy. They use it for a group policy. This is the most basic form of life insurance. Okay, the policy renew each year without proof of insurability. That's mean even though you have to renew it every year, you don't have to prove that you are in good health. Okay, and also the premium increase yearly due to attain age, because your age goes up, it's gonna cost you more money. And also usually it's limited to certain numbers of renewals or to a certain age. They're not gonna let you renew forever. There's a period of time they may not allow you to renew it. Okay, so this is called an ART. That's what that means. ART, annually renewable term insurance. So now know those features. You have to renew it every year without proof of insurability. Okay, you're gonna renew without proof of insurability. Okay, now as the premium, as your age goes up, the premium gonna goes up. But you use it for what? For a group insurance. Annually renewable term, they use it for a group insurance. Also, that's one feature of a universal life insurance. So a universal life insurance also use annually renewable term insurance, by the way. All right. So increasing term. That was the last one we're going to talk about here. Increasing term. Just like you say, something increasing. Because if you say something increasing term, okay, it's a term insurance that's increased. But now what I need to know about this, what increase? Again, remember, any of those insurance, the face amount, you gotta depend how the face amount behave, he will tell you what kind it is. And increasing term insurance, it's a term insurance that the face amount goes up. Now the decreasing term, the face amount goes down. The level term, the face amount remain the same. But none of those policies have any cash value. So none of this, the lower term, the decreasing term, return of premium term, maybe annually renewable term, increasing term, none of them have cash value because they are term insurance. Once you see the word term, just put that in your head. No cash value. Excuse me. Now, from the increasing term, guys, and the decreasing term, and the lower term, the premium is level. The premium do not change into those policies. The only time the premium change is when you have an ART. Just put that in your notes. That's the only time that premium change. Why would somebody use the decreasing term? Well, the death benefits increase at a specific time. It's usually purchased as an increasing term rider. So that's somebody, for example, let's say that if you have a client who's not married, but they're planning to get married in the next couple of years. But right now, they don't need too much insurance because it's only them. But once they got married, now their family gonna be more people. So that's when the responsibility gonna be higher. So at that point, they need more insurance. So that person will need an increasing term. Why? Because you're gonna need more insurance. What about if somebody say, listen, next year I'm gonna make way more money, or maybe I'm gonna have more asset. Okay, the more valuable you become, also you're gonna need more insurance. Okay, that's how you gotta think about the increasing term, but not because you're going to buy a house. Because you're going to buy a house, that's debt. That doesn't mean you need an increasing term. Most likely you might need a decreasing term. That's why I can see why they take that out. But if you're gonna have kids, oh yeah, you need an increasing term. If you're gonna get married, you need an increasing term. If you're gonna make more money, you need an increasing term. But if you're gonna buy a house, you need a decreasing term because that's a mortgage. So level term, decreasing term, increasing term. Those are the two types. The premium do not change. It's only the face amount. Depending how it's behave, you know which one it is. All right. What question do you guys have? Any question? Do you guys have any question? Cassandra, I'm in the class. Really, map. Call me after that. I'll tell you. Yeah, get that data bird, okay? Yeah. All right. So, all right, guys. So just know that's all. I did ask, do you guys have any question about this? Question about this? Because everything we're gonna be talking about now, there's some special feature I'm gonna cover about that, so we can be done with that part of it. Okay. So we're gonna be done soon. So there's some special features of it. For example, there's two features you find in term insurance. Is what we call renewable, that's been option to renew, and also convertible, option to convert. Convert to what? We knew about how we do renewal. So some term insurance, not all of them, but some of them come with something called renewable. Now, when you see the word renewable, that means you can renew that policy at the end of the term, okay, without proof of insurability. You can renew without the term, okay? That's when you can renew that policy, okay, I'm sorry. You can renew it without, proof that you're in good health. So that's when that policy is guaranteed renewable before the policy terminates without evidence of insurability. So if you're reading a test question, somebody should say renewable term insurance, guys, that's when they can renew without proof of insurability. That's what that means. They don't have to go do tests again. It doesn't matter if they get cancer or HIV. It doesn't matter. They're gonna have to be able to renew the policy for them regardless. Except the premium gonna go a little bit higher, but they don't have to go test. It doesn't matter. That's what that renewable. That's why when people purchase a term insurance, you always need to make sure it's renewable. It's guaranteed renewable, no matter what. Also, premium increase, of course, you know that because of the age, and can also be renewed for a limited number of time to certain age, usually 65. Okay, so 65 is not going to be tested, so you don't have to worry about that crap. Okay, but just so you know what renewable mean. So now, this is why they could trick you on a test question. They might say something like this: so and so purchased a policy for 10 years. It's renewable term insurance, or maybe say so and so purchased a renewable term insurance with a convertibility option. That's mean it's renewable, it's also convertible. What would happen after the 10 years? Or they might say all of the following are right except. Or they might say which of the following is right except. Okay. So now if you have it, they renew after at the end of the 10 years, you can renew for another term, except the premium gonna goes up, but you don't have to prove that you're in good health. Or at the end of the 10 years, you can convert to what? To a whole life insurance, not another term. Term to term is not conversion. Conversion happens when you convert from a term to a whole life. Put that in your notes. Never forget that, because they try to trick you with that one. So you can convert to a whole life without proof of insurability. You can convert to a whole life without proof of insurability. I don't know how to choose that to you, man. I don't know what's going to be the exam, but I think if the exam try to trick you, I try to get you clear. All right. So now the convertible mean the option to convert from a term insurance to a whole life without proof. Just remember that is without. Sometimes they just take the OUT out on it. They just leave with evidence, I'm sure. And then that's what you pick because you are trying to be in a hurry, not reading the whole sentence. And you miss the question for just with and without. With is different thing. Without is a different words. Without, that's mean you don't have to prove you're in good health. With mean you have to prove you're in good health. Conversion must usually be done within certain time by this specific age. They will allow you to do the convert at certain age limit. So those are pretty much it about that. That's it. That's all the term. That's all about it. It's that simple. No cash value, pure protection, pure life insurance, and there's three types: level term, decreasing term, increasing term. There's an annual renewable term insurance. There's a return of premium term, and they have features. The feature they have renewable, and convertible. Just like the whole life have their own features. The whole life have a cash value features. They have an automatic premium loan features. Okay, there's different thing, but that's all you need to know as far as when it comes to term insurance. Question? Nobody have any question, guys? I've been no, I don't. I guess everybody's sleeping. I don't understand why you guys don't have a question. If you're not driving, go to the participant window, give me a yes. Go to the participant window, just give me a yes. Okay, that's mean some of you are paying attention, some of you not. Okay, well, let's go to the next one. I'm gonna cover the next one for you. Now we're gonna go to the big guy, whole life. We're done with that. Now let's talk about the whole life. Whole life insurance. Whole life. Whole life. That's mean everything is guaranteed. The face amount, the premium, the cash value until death or age 100. Until death or age 100. So that's mean everything is guaranteed until you die or you live to age 100. Cash value is depend upon the face amount. Okay, so the amount of premiums and how long the policy has been enforced. So based on those two things, then we're gonna know how much cash value this policy might have on it. So it's the amount of money that you pay every month and how long the policy been enforced. Whole life. If we don't want to say whole life, just like on the term, if we don't say term, you say temporarily. On the whole life, you can say cash value or permanent. Those are the name for whole life insurance. So on your test, if you see someone to purchase a cash value insurance, that's when they refer to the whole life. If you see that somebody purchase, okay, if you say that somebody purchase a permanent insurance, that's when they refer to the whole life. So if there's somebody buying a whole life, they refer to the permanent or the cash value. That's what that means. When you see they say that, that's mean there is cash value on that one. Every whole life must have cash value. It's a feature that's come with them. And then it lasts until age 100. Okay. Now, some of them might last longer, but if you want to pass the exam, you won't need to know they last until age 100. If you live to age 100, the policy owner or the insured which is gonna receive the money. Okay. All right, let's see what type of whole life there is. The first one that we're gonna talk about is what we call ordinary or what we call straight life. Remember when I was explaining the level term? Level means straight. That's mean in ordinary life insurance, even though it doesn't say whole life, you better know that's a whole life insurance. Ordinary means straight, just like a level term. It does not change. So when you get that policy, you got to pay the premium from the day you have it all the way until age 100. Nothing changed. The face not gonna change. The premium not gonna change until you live to age 100 or you die before age 100. That's why it's called straight life. It's a basic policy. That's a level death benefits. The insured pays the premium for life or until age 100. So when they say until for life, that's when they can die before age 100. So that will be the life. Or if they live to age 100, they're going to pay it until age 100. So this is the basics level death benefits. And now it takes about 3 years to build cash value. About 3 years to build cash value in ordinary life insurance. Even though I don't mention whole life, just so you know, any of this whole life insurance. The next one we're going to talk about teammates is what we call a limited pay. A limited pay, just like you say, limited. But now think about pay. What is pay? It's a payment. Okay, but how long is the payment? It's limited. Except we don't know yet how long is limited for, but limited pay, just so you know, if you read between the lines, something is going to be limited for a period of time. So that's when that person do not have to pay forever. That's why you call it limited pay. There's a limit to pay. After that, no more payment. All right. So now, for example, they may not say limited pay. They might say life paid up at age 65. So now, if you see this on the test question, you better make sure you know they're talking about a limited pay insurance. That's a simple question. Easy, busy. Now, if they say 20 pay, that's mean it's a limited pay as well. So now, when they're talking about limited pay, guys, they refer to a 20 pay whole life or a life paid up at age 65. Meaning, if it is a 20 pay like this one, you have to pay the premium for 20 years. So let's say if you're 20 years old, if you buy this policy, you're going to pay the premium until you're 40 years old. And after that, you don't have to pay anymore, but you're not going to get anything until age 100 or you die. That's what they call limited pay. That doesn't mean because you're done paying it, that doesn't mean they're going to have to give you the money. They ain't going to give it to you. Okay? Now, if it is life paid up at age 65, that's mean you're going to pay that premium until you turn 65 years old. But even though you're done paying the premium, that's why you call it limited pay, you don't have to pay anymore at age 65, which is, that's not bad, okay? Now, but they're not going to give you the money. They will not give you the money. You still have to live to age 100 or die for your family to get the money. All right? This is called life without age 65. Now, look at this. All the premium are paid up. That's mean, although you finish paying, okay? So have to fin pay. Coverage remain to age 100. That's mean the policy lasts until age 100. You just have a policy that's done pay for, and that's called a limited pay whole life insurance. Question? Give me a second. Hold on. I'm able to drink a drinker, so I got to drink. If you see me drinking, don't bother me. Okay. Alexandra, we glad you're here. All right. So you guys, if you guys have any question, that's great. I'm gonna continue. Now, let's talk about another whole life policy. Another whole life policy that you're gonna find, okay, is what we call a single premium whole life. A single premium whole life. So that when we talk about that single premium whole life, give me a second, hold on. Okay, it's good. What does single mean? What's single mean? Single mean, look at my finger. When you single, you know what that means. That means you don't have a boyfriend, or you don't have a girlfriend. That means somebody can teasing you. Somebody can joke with you, man, because you're single. Single means single. Ou célibataire. But what's single on this one? This is insurance. They go back to insurance, okay? This means it's a single premium. That's mean you pay the premium, but how often? Once, one time, and at inception. Inception means in the beginning. You pay one premium, this is it. That's it. One time. So premium paid in one lump sum, and coverage continues to age 100. Because you pay one lump sum, guys, okay, because you just pay one lump sum, you pay all the money at once, one time, that's mean this whole life insurance is the only one that start building cash value immediately. That's mean that type of policy, at the minute you're done paying the premium, it start building cash value right away. Only a single premium build cash value immediately. Everything else take like usually 3 years before you can see any money into that policy. But a single premium It build cash value right now. This going, once we get it, it's gonna build it right now. So immediate now. Now you're gonna do it. One payment. You make one payment. But you still have to keep the covenant until age 100. That's mean you have to live to age 100, or if you die, your family gonna get the money. But if you live to age 100, you get the money at that time. Even though you make one lump sum, let's say for example, somebody who's 45 years old, buying $100,000 single premium whole life. So he pay all the money at once in inception. He pay the whole premium, but it's covered for 100,000. Even though he's done paying that, they're not going to give him the 100,000 unless if he die or reach to age 100. That's it. That's it. Because what happened is when you have a whole life insurance, as you're making the payment, the cash value going to equal the face amount at age 100. That's why you get, they cannot give you both. You can either get the face amount or the cash value. You can't get both unless there's an exception. If you have a universal life insurance, that's option B. If you have that, that'll be able to help you that. We might be able to find that a little bit down below. So, question on that? Okay, if you guys have a question, I say if you do have a question, you got to answer. Other than that, you have to hold your peace forever. If you do have a question, and let us know. Now, let's talk about adjustable life. Based on it, on the name, that's why I really like when they talk in the Bible, Adam was giving all the animals name, and every name that he gave them, it looked like them. That's why a pig, you see a pig, you see what the pig does, the name matching the characteristic. Same thing with this. Adjustable, something is being adjusted. just like I said, something is adjusted up and down. I'll be left and right, front, back, adjusted, adjustable. That's what that means. Something being adjusted. But we need to know when somebody have an adjustable life, there's one thing that can ever change. Put that in your notes. The insured can never change into that policy. You can change it from a whole life to a term. You can change it from a term to a whole life. But you cannot change the insured. If I have a policy on myself and is an adjustable life insurance, you can't change it. You can change it to a term insurance, but I'll still have to be the insured. You can change it to a whole life insurance, but I still have to be the insured. You can put the premium up. You can put the premium down, but I still have to be the insured. So, in adjustable life, you see what can be changed. The coverage, the premium, the type of the plan. So that's what that means. There's three parts on the adjustable life. Know that, guys. Adjustable means flexible. You can change the coverage. There is the premium you can change as well. There is the type of plan. When they're talking about type of plan, you can change from term to whole life. Any whole life, any term. It doesn't matter. That's what that means. So there is a lot of people, guys, when they go to the exam, they see an adjustable life insurance. They pick it can only be term insurance. Who told you to do that? Or there's some people, when they go take it, they say it can only be whole life. Oh, come on. Even though we are in the whole life section, I just explained to you that's an exception. It can be whole life or it can be term. That's the only one that can be either or. Just that was the right answer. Some people say, no, it can neither be a whole life, neither a term. But what can it be? Oh, teammates, come on. Come on. I got to have fun with you. All right. Pay me no mind, even though I'm drinking. I got to drink. The insured chooses two of the three, okay? And the insurance company pick the other one. Look at this. What does that mean? The insured chooses two from those three. There's three parts. You can pick two. and the company gonna determine which one it is. Okay. So now, what do I mean by that is this. Let's say that if you decline, you say, listen, I need $150,000 policy, and I want to pay $100 premium. Okay. And the insurer gonna say, okay, since you pick those two, which is that's what they say here, the insurer gonna pick one. Then he's gonna tell you which type of plan he's gonna give you. Well, based on what you just say 150, $100 a month, and you're 45 years old. Then I need to give you a term insurance. Boom. Now, let's say if you're 65 years old and you say, listen, I need $20,000 or $25,000 policy, and I need to pay $150. Oh, then they give you a whole life or a term. It's up to them. Let's say if you say, listen, I need a term policy and I want to pay $100 a month. Okay, they're gonna tell you how much coverage they're gonna have to cover you. Let's say that you say, listen, I need a whole life insurance for $10,000, and they will tell you how much it's gonna cost you. So you can't pick all three. Once you pick two, the company give you the other one. What is gonna determine what that is. Now, adjustable, you need to know flexibility in the plan type. This is that's mean, for example, the insured may have the term to age 65, then change to a whole life, okay, as needed. So they can go vice versa. So that's when there's flexibility into that policy. Now, because if there's that flexibility, would you agree you got to pay more money because they make it flexible for you? So if you can change back and forth, then that's what happened. Think about if you could use a gym membership, for example. If you have a gym membership and they say you can only use one gym, and that's the only gym you can use. But if there is a card where you can use any gym, okay, but the same way, don't you think they're gonna charge you more money? Of course, yes. Of course, yes. Because they give you more features. That's the reason. Okay. Any question, teammates? If you don't have any question, you're gonna have to hold that peace forever. I keep saying that. I'm gonna continue. Now, there is some more whole life insurance. Those are a little bit more complicated, but we're gonna cover them. There is what we call interest market sensitive life policies. What that's saying, don't get all those would trick you. It's just saying that this type of policy, they are sensitive to the market. So depending how the market function, if there is a good market, you might have a good policy. If the market is terrible, you may not have a good policy. That's what they're saying. Because it's sensitive to the market. So now, let's talk about universal life insurance. When you see universal life insurance, think about flexibility. It's flexible. In a universal life insurance, there's two things. Two things that flexible. The premium and the face amount. So that's when you can put the premium up anytime, down anytime. The face amount, same way. Now, there's two rates of return on the cash value. There's a guaranteed minimum rate, or there's a current rate set by the insurer. Now, there's two types of death benefits, guys. Two types. Option one, if you go on the exam, they say option one, it can also refer to option A. Option two can also refer to option B. Now, in option, remember earlier, I did say something earlier. I'm going to mention that now after we get to this one. Because there's a type of policy where you can get the cash value and the face amount. Because usually that's not how they write those policies. But there's an exception to this rule. And I'm going to cover that in the next couple minutes. So now let's talk about option one. Death benefits, okay, equal cash value plus the decreasing term. It has a corridor to protect the policy from becoming a MEC. The corridor is there to protect the policy to become a MEC. Now, MEC means modify endowment contract. That somebody back in the day people was wanted, to hide money from the government for them not to pay taxes. So since insurance is not taxable, so the people that have a lot of money wanna, hide their money into insurance policies. So the government find out that's what they've been doing. So they say, oh yeah, that's what you guys been doing. Because you guys are cheaters, I'm gonna come with new rules and regulation. So now, if you guys ever put more money than you're supposed to in the 7 years period, that policy gonna become a MEC, a modified endowment contract. So that's when it no longer called a life insurance policy. So it's no longer tax-free. Everything is taxable now. Even the cash value become taxable. If you're taking a loan, it's taxable. Everything on it. It just turned it to a retirement account. That's what a MEC is. Once a policy turns to a MEC, it's gonna remain a MEC. It can't go back to become a life insurance. So a universal life insurance, you find that's why they put a protection called the corridor to protect the policy from becoming MEC, because they don't want that policy to become a MEC. Because if it does, what's gonna happen? That policy gonna become just like a retirement account. They're gonna have to pay 10% penalty if they go before 15.5, just like a 401k. Okay, because that's what that turned to. It turned to straight to a retirement account. But except they don't call it that, since it was a life insurance that's exchanged, that turned to something else. They called it modified endowment contract. That's a MEC. Okay. So now if they tell you which option that have a corridor, just so you know, option 1 or option A. The corridor you're finding in option 1. That could be a test question. If you go to a test question, then talking about the universal life insurance, and you see A, they put option 1, B, they put corridor, C, they put option 2, and they put some other crap. Now, be smart. If you see A, say corridor, and B, say option 1, they mean the same thing. So there's no way this could be the answer. It must be option 2. Okay, just for your information. All right, so now let's talk about option 2. Now, that's the only one, guys. The death benefits and the face amount plus the cash value. So that's the only type. If you get it universal life insurance, if you have that type of policy, you get to collect both the face amount and the cash value. The face amount and the cash value. Because now the face amount gonna goes up by the cash value. So based on how much the cash value goes up, so the face amount will goes up as well. So this is about universal life. When you see that, now the other thing I want to mention to you, while I remember, universal life insurance, there's 2 things on it. There's a cash account and an insurance component. There's 2 components. There's an insurance component and a cash component. So the insurance part, it's annually renewable term insurance. That's what that is. Okay, annually renewable term insurance. Okay. Sorry about that. Okay, so that's what that is. And also universal life insurance, you have to understand the flexibility. It also have a partial withdrawal or a partial surrender. If you ever go to a test question, you're reading a test question, teammates, they're talking about partial withdrawal, partial surrender, they're referring to a universal life insurance. I don't know, man. I'm telling you exactly how you should study. If you want to pass the exam, I'll tell you what to do if you want to pass it, okay? Any question? Okay. So if there is no question, we're going to continue. The next whole life we're going to talk about is what we call a variable whole life. Now, remember, those are sensitive. So now, when you see something variable, teammates, anything that's variable, that's mean you need 2 licenses, by the way, to sell that. You need a life license and a security license, what we call an investment license. You need that. So variable life, that's mean what varies is not the face amount really they're referring to. Most of the time they're talking about the cash value. Because the cash value, that's mean that cash value is not guaranteed because of the market. As the market behaves differently, the cash value bounce all over the place as well. So now, let's say that cash value invested in the separate account, and not guaranteed. So now this type of whole life insurance, the cash value invested into a separate account. But if you has a regular whole life insurance, the money invested into a general account. But because this is a variable, there is what we call a separate account, which is they refer to the investment part. So that's the reason the cash value is not guaranteed. Now, when somebody purchases a variable life insurance, policy owner assume the risk of the investment. The policy owner assume the risk. So that's mean you are the policy owner. You take the risk. You say, I choose to invest my money instead. But that's at your own risk. What about is it required 2 licenses or the dually licenses? Okay. It's regulated by the state of life insurance because part of his insurance. It's also regulated by the State Department of Financial Services and what we call register with FINRA. So that's when it's regulated. You got to get a FINRA license, what we call the investment license, and it's regulated by SEC. So if you have a variable life insurance, when we talk about that, is this. It's regulated by the state insurance, FINRA get involved, the SEC get involved. But if you have a variable annuity, which we're gonna talk, which is the annuity, is the opposite of life insurance. Annuity is not a life insurance, so therefore it does not regulate by the state insurance. Just put that on your notes for now, just in case I forgot. Change to keep pace with inflation. The reason somebody buy this is because they want to keep pace with inflation. That's why they buy it. Because as inflation goes up, this policy perform as well to keep up with it. So remember, the premium is still level, but the face amount can be based on the performance of the separate account. So that both the face amount and the cash value varies. But put that in your notes. There's something I'm going to tell you this is very important. Let's say that I purchase $100,000 variable life insurance. So I'll call it VA, variable life insurance, or a VWL. No, not VA. Not VA. VA is for variable annuity. A VWL. A VWL is mean variable life insurance for $100,000. When I get this, teammates, if I buy this type of policies for $100,000, if I die, even though the face amount can go below $100,000, I can never ever get less than $100,000. The minimum I can have until that policy if I die is $100,000. But I can get more money. That's why I buy it. Because if the face amount get to $150 and I die, I'll get $150. But if the face amount get below $100, let's say $80,000, I will always get the minimum that I started with. Note to keep on your notes. I don't know how to stress this part to you. Make sure you get that. If you do have a question on that, you don't get it, tell me. Moving to the next one. Again, excuse me. I said anything variable, you need 2 licenses. The minute you see it variable, 2 licenses required. Now, think about this now. This is a variable universal life insurance. Is what happened. They take this features in here plus this and it turn to this. See, it is so confusing, too much stuff. But think about it. That's what they do. They can take all this thing here plus all this thing here and it equal to all this thing here. So universal life plus variable life equal variable universal life. Now this policy, it's also behave. It's not guaranteed The face amount and the cash value is not. The face amount, the minimum is guaranteed, okay? But the cash value is not guaranteed because the performance is going to be based on the performance of the separate account, okay? If the separate account not perform good, that cash value is not going to do it well. So if the face amount, also, if the market is not doing great, the face amount might go below, but at the same time, you're not going to get no less. Remember the same example I gave you earlier? Let's say that, and this one is not, there's no flexibility in this one. But now this one says, I want flexibility. So it's blending universal life insurance and variable life together. So the premium is flexible, okay? So now you see the premium is flexible in this one, but the premium was level here. Why the premium is flexible here? Because the flexibility comes from here. This was this level, but this one is flexible. So when you take flexibility here plus level here, that's why the premium becomes flexibility down. Because so now the cash value is invested control. So they invested with control. Okay, that's when they invested the money. The death benefits is flexibility as well. This has mean the face amount is flexible. It can go up, it can go down. So just so you know, that's what that is. So you need 2 licenses to sell both of this product. Now you find another whole life insurance. It's what we call interest sensitive whole life. It's also known as a current assumption whole life. So that's an interest. It's based on how the interest is doing, how the market is doing. This one actually really sensitive with the market. Premium may vary based on the insurer experience with invested and the death benefits. Cash value may also vary. So when you find the type of policy estimates, it's sensitive to the market. It's sensitive to it. It's depending. If the market not doing well, this policy is not going to do well. I don't know why people buy them, but they do. There is another one called equity index. Now, when you see the word index, is a type of it's I'm gonna explain to you. It's just like every time people see an index, there's different index. But usually when they're talking about index, they're referring to the S&P 500, which is 500 companies. Okay, they pick the 5 top 500 companies in the US. That's called an index. Okay, just like it's mirror the market. Equity means stock. So an equity index life. So this is a face amount increase based on the performance of the equity index. So such as the S&P. If the S&P is doing well, this policy is gonna do well as well. But it's also got a guaranteed minimum interest rate that's fixed, and the premium is fixed. So let's say that somebody, whoever purchased this estimate, think about this way. Let's say you buy an equity index life. So that's mean they give you a guaranteed minimum interest rate. So now it doesn't matter if the S&P come back -0 or you have negative like whatever. If your minimum is 2%, no matter what the S&P does, you're gonna get the 2% if you go negative. But if it's positive, let's say it give you more, then you can get a chance to earn more money into the equity index policy. Now, I think those are the couple more. After that, we're going to get to the annuities. Okay, 2 more from the whole life. Joint life, first to die. And they try to trick you on the exam with that one as well. Joint life means first to die. When we're talking about joint life, first to die, that's mean 2 or more insured. That's mean joint life, survivorship, okay, second to die. So both of these policies, they cover 2 or more people. So now, if you are reading a test question, they try to 2 people want to get insurance, and they ask you which policy would be good for them, a joint life or survivorship, depending what they want. Depending what they want. What is the joint life? Let's say that me and my wife get the policy. Boom. 150 for me, 150 for her. If something happened to me, I die, the company pay her. That's why it calls first to die. So once they pay, hey, they done. But they cover me and her, 2 or more. Now, they charge us the premium not based on my age or her age. They're going to charge us the premium on the average of our age. So they're going to take my age and her age, and they're going to divide it by 2, since it's 2 of us, and they're going to charge us based on the average age. That's why this type of policy is lower premium than 2 individual policy. Meaning that, and that's, they could put actually that on the exam. That's why I explained it to you. If you don't get it, go back, listen to that little part and review it until you get it. So now let's say that because you covered me and her, what happened if we decided we didn't want to get a joint life? I get the policy by myself. She got the policy by herself. So that's when I have an individual policy. She got an individual policy. So because we have two different policies, it will cost more money than the joint life. Okay? So make sure you get that. So now, joint life, first to die, is covered 2 or more insured on the same policy. The policy pays the death benefits when the first person dies. Less expensive than individual policies, since the age are average. They average the age. Those are questions you should know on the exam. Okay? So joint life, remember, first to die. Joint life, first to die. Survivorship, second to die or last to die. Okay? Make sure you know that. It's covered 2 or more insured on the same policy. The policy pays the death benefits when the last person dies. For example, remember, I just give you an example. My wife, okay, and I, we get the policy. So now, if it was a joint life, once I die, they'll pay her. Now, because this is a survivorship, when I die, she gets nothing. They have to wait. When she dies, that's when they're going to pay. But you might say, why would somebody buy a policy like that? Well, there's people that are going to have, when we pass away, we might have a lot of tax liability. Then we use the insurance to cover the taxes. That's called state conservation. We can, because so sometimes we might have asset that, you know, after I'm no longer here, everything gonna go to her. And when she's no longer here, we're gonna have a lot of tax bill. So, and especially if we have kids behind, we can get the policy like this. It's not because we got the policy, not because we want the money. That's why we say second to die. Because it's not because we want the money. We want to leave the money for the people behind to take care of things that they need to take care of. That's why that policy even lower premium than this one. So this one paid the lowest premium, this one, then this one, and this one paid lower premium than the 2 individual policy. Okay, so that's it. That's it for that question. Hopefully you're learning some great stuff. This one is not the most fun part, but you got to know them. There's 12 questions on your exam about that. 12 questions. So remember, I said life insurance, you buy it because you can die now. You create money now. That's what that is. Life insurance, you create money now. That's what that is. Create money. That's what that is. So you buy life insurance in case you die right now. So what happens if you go on the exam and then when you're in the exam, they say, why would somebody buy a life insurance instead of an annuity? Because the annuities is the opposite of life insurance. Annuity is the opposite of life insurance. You buy life insurance in case I die right now. I leave a bunch of money for my family. I get an annuity in case I live longer. I need retirement. I buy an annuity for retirement income, for money. That's me enjoying the money, not people that are going to enjoy after I die. This is my money. I'm going to be able to enjoy. So annuity is the opposite. But you might say, why would somebody buy a life insurance instead of an annuity? The person buy the life insurance instead of the annuity to create an immediate state, meaning that to create money now if I die right now, because the annuity take longer to build. That's why somebody will buy life insurance instead. Okay, so make sure you know that. Now let's talk about some characteristic of an annuity. An annuity designed to provide income for a number of years or for life of the person. Okay, know that It's something that can last for life. As long as the person living, he's gonna continue get money if they do it the way, depending the option they selected. So it's designed to provide income for a number of years. Now, this is not a life insurance, but it's sold by insurance companies. So insurance companies, they're the one that sell that product, but it's not a life insurance. Now, it's a method to liquidate in state or a large sum of money. It's a way to create a big chunk of money to liquidate that, maybe in small amount of money for the annuitant. Uses mortality tables that reflect a longer life expectancy than the life insurance. Because now they still use a table, same thing, life insurance use the table, the life expectancy table to see how long that person can live. That's why they say they expect that person to live until age 95 or maybe age 86. It's all depend. So based on your life expectancy, then the annuity, they're gonna pay you based on that. But sometimes they're not really sure. They might expect you to live for another 20 years. You might end up losing 10. Sometimes you might end up losing for more than 20. So they don't really sure for sure, but that's what they expect. But it's not really a definite number. Okay. So now, many people say, Ernest, listen, when I go to that exam, man, I don't understand. I got a bunch of questions about annuity, man. What is that annuity thing is? What is it? It's so complicated. No, man, guys, this thing is the easiest thing in the world. It's just, think about an annuity where you're putting your money into a bank account or a savings account. Eventually, I'm going to start taking all that money until I'm no longer here. That's all that an annuity is. A life insurance in case you die. But I'm saving my money in annuity is in case I live for a long time, I need money. That's it. Don't mix them. There's nothing to be mixed. Okay, let's see the poly to the annuity. Just like when you buy life insurance, we find what we call a policy owner. A policy owner. But when you get an annuity, you find an owner, not a policy owner, but you find an owner, an annuity owner. So whoever owns it, they're the one that purchased it. They're the one that have all the rights. They're the one that's supposed to fund it. They're the one that's supposed to put the money into that account. Now, remember when you study life insurance, they refer to the applicant later on and insured. But into an annuity, they refer to the person an annuitant. Now, listen to me. Put that in your note. Put that in your note. An annuitant must be a natural person. You cannot put your corporation as the annuitant because we cannot measure the life of a corporation. Because imagine this company, the life insurance company, gonna send you money for the life of your corporation. How long your corporation gonna survive? Forever. But the annuitant must be somebody that can be dead. Somebody that's going to even have to be a person. Okay, so the person who received the benefit from the payment from the annuity and who's the life expectancy, okay, that's the one that they use, the life expectancy of that person, okay, now may not be the same person as the owner. So that's when what they're saying is, same thing, when you get a life insurance, the policy owner and the insured may not be the same person. So also when you get an annuity, the owner and the annuitant may not be the same person. For example, let's say I'm rich, I got money. I may not be able to do my annuity for myself, but I can open an annuity for my mom, but I fund it. I do it for my mom. She's the annuitant. They're gonna use her age, not mine, even though I'm the one that owns it. But they're gonna send her the money, the check, not me. It's gonna be based on my mom age because she is the annuitant. That's what they're saying here. So beneficiary is a person who received the benefits if the owner died during the accumulation phase, either the amount paid or the cash value, whichever is greater. So let's say I do the annuity for my mom. At that time, she's the beneficiary. So I can also put somebody behind my mom for a beneficiary as well, but she's the beneficiary and she's the annuitant. So if something happened to me while I'm putting money into that thing for her, So she get to get the money. It's either the cash value or whatever I pay into that annuity, whichever is higher. Whichever is higher. Okay? Same thing, my mom could just do it herself. She will become the owner. She also the annuitant. And she can put me at that time, since I'm her son, so she can put me as the beneficiary. But my life has nothing to do with that. It's based on her age. She owns her stuff. She can cancel it. She can put money on it. It's up to her. Question so far? If you don't have a question, guys, go to the participant window. Give me a thumbs up. Give me a thumbs up. Wait. Oh, where do I find the thumbs up, by the way? I don't see the thumbs up. If I can't, what you can do, give me a green check mark. You say, yes, I got it. I know some of you not paying attention. When you get to the exam, you're going to have fun. You're going to remember, oh, RVP, I wish I did pay more attention. Just, I know he was talking about that. I heard he was, he did. He tried to put it in my brain, but why? I was so sleepy. I could not focus. I got put out to the exam. Let me sit for just 1 point. Maybe it could have been one question like this could have saved him. Okay. Thank you, Galaxy. I get your green check mark. Thank you. All right. Don't go to sleep on me. Okay, so I guess we're gonna have to go down after I go switch to the next page, to this page over here. Don't worry about it. Let's go back. Now, accumulation. What they're talking about now, how do we put money into this thing? Accumulation means you accumulate. When you're putting money into an annuity, that's called accumulation. Accumulation. Annuitization means, okay, the money, I've been putting money in this sucker for the longest. So now it's time for me to annuitize that sucker. And I need my money coming back to me now. So money going out. That's called annuitization. Mommy coming out. Okay. Accumulation. This is what we call the pay-in period. Let's talk about that. So another name for accumulation is pay-in. This is when the interest earned tax deferred basis. So the interest is gonna go tax deferred. Deferred means you don't have to pay taxes on that annuity right now. You're gonna pay taxes when you start taking money out. So if I don't want to say the accumulation period, I can say the pay-in period. That's mean put in money, pay in money, pay in money. Period means for a period of time. I'm putting money into that annuity, and while I'm putting that money, the interest I'm gonna earn, I don't have to pay taxes on it. You're gonna go tax deferred. Sexy, isn't it? Now, I'm done putting money in. I'm not putting money into that sucker again. Now, I've been giving you guys a lot of money. I got a few $100,000 in there now. I'm not giving you guys any more money. Now it's time for you to start taking care of me, baby. I need money. So now what you do, you call the company, you say, I am going to annuitization. So I'm going to annuitize my money. So annuitization means annuity period. So if you don't know, say annuitization period is the same thing, or liquidation period. Also, you can say the payout period. This is when payment go to the annuitant. This is now money coming to me. I'm the annuitant. I'm getting money back now. So they send me a check for the rest of my life. It could be for the rest of my life, or it could be for a period of time. Depend what settlement option that I choose at the time. So, on the test question, make sure you understand that annuity period, that's the payout period. This is when payment, that's when money coming out from the annuity. The money coming out, because you're not putting money in anymore, money coming out. So that's two ways. Okay, make sure you understand what those two. And usually you can get tested on that as well. Okay, take good notes. So how can we pay the premium on that thing? How do we put money in it? Well, there's a couple ways, really. But one way, single premium. Again, remember single premium on the whole life insurance? What did I say about single premium? You take all the money, you jump it. Let's say somebody who played the lottery and they win and they got maybe a couple $1 million. And they say, listen, I have so much money right now. I need an annuity. I need to secure my retirement. And they take a couple $100,000 from that millions and they give it to an insurance company to do an annuity for them. So they give them the whole amount at once. So that couple $100,000, they give it to them. Now, that couple $100,000 going to grow tax deferred basis. That's a single premium. So now that's a one-time payment. They just put all the money at once. Remember, in the whole life insurance, when you have a single premium whole life, it builds cash value immediately. You start doing cash value now because you don't owe money on it really. So you're going to start building up cash value. So this is an annuity where you put the money at one time, inception. What about periodic premium? Periodic, just like I said. If it was a period of time, it's a period of time. That's when you do it over and over and over for a period of time. Maybe 1 year, 5 years, 10 years, who knows? This is the same payment frequency. Okay, same payment frequency. Accumulate fund for retirement. Now, when you do a periodic, you can do it level premium or flexible premium. Now you're telling me after you see level premium, flexible premium, you want me to explain what that is? Come on. You don't need somebody to explain you that. If you already see my first slide from the beginning, if I explain that to you, I told you what level means. Level means it doesn't change. When something do not change, it means it's fixed. You see the table that's in front of me here? It's fixed. It doesn't change. You see the webcam? It's fixed. It doesn't change. Okay? So now, that's what people need to get. When we talk about level premium, that's when the premium is fixed. It do not change. So if the premium not going to change, let's say if I'm putting $100, every time I just put 100, it's 100. It's for life of it until they say no more payment. Now, flexible premium mean it varies. It can go up and down. That's all that's saying. But what goes up and down? The premium. It's flexible. That's it. I think this is easy to remember. The way you put money into an annuity is cash. Cash. You put money into an annuity, cash. I don't know if I'm going to see that somewhere, but whatever. When do you benefits begin? That's something that's very important for us to know. When benefits going to start? When benefit begin? So now it depends. There's two ways, not a bunch of time. There's only two ways benefit begin. It's either immediate versus deferred annuity. So there's two types. Now depend when the payment going to start. That's when you're gonna know which type I have. So now for your notes, immediate mean if you're somebody have an immediate annuity, that's mean payment begin within 12 months. When they say within 12 months, guys, that's mean if somebody purchased an annuity and they tell you they're gonna start receiving payment next 2 months or a month after, or in the next 30 days, or in the next 8 months, or in the next 9 months, or in the next 11 months, they're gonna start taking money out. That's telling you that's an immediate annuity. That's simple as that. So you with the question, you pay attention what the question is saying, then you try to find out, is that person taking money before 12 months or after 12 months? If they're taking it before 12 months, it's immediate annuity. In order for you to have an immediate annuity, you have to do a single premium. You cannot do periodic immediate because when you pay, you don't have enough money in that account yet. So the only way you have immediate, it better be a single premium. Now, the other one is deferred annuity. That's mean payment begin after 12 months. So let's say the person purchased that annuity And they say they start, even though they give a lump sum, it doesn't matter. But they're gonna receive payment after the 12 months. Okay, after 13 months, maybe 24 months, maybe 48 months, maybe after 5 years. This is called a deferred annuity. Depending when they start taking money out, he tell you what kind it is. Oh, that's sexy. Why you don't want to learn this stuff? That's so great, teammates. Oh, this is beautiful. Oh, come on. Come on. Come on. Single premium immediate annuity. Single premium immediate annuity, payment only. So that's just like I said, somebody who hit the lottery, he might hit the 2 million. He might say, hey, listen, I'm going to give you $500,000 or maybe $1 million. But you got to give me a paycheck starting next month for the rest of my life. That's called immediate single premium. That's an immediate single premium annuity. That's what I meant. It's the same way. The person can say, listen, I'm going to give you $1 million, but don't pay me until the next couple of years. After 2 years, you can start sending me a paycheck for the rest of my life. That would be a deferred annuity, a single deferred annuity. Or if the person said, hey, listen, I'm going to give you like $500 every single month for the next 10 years. But after 10 years, you're going to have to send me a paycheck for the rest of my life. This is a periodic deferred annuity. I love it. It's not confusing. That's easy. Easy. Easy as the cock. Question. If you like what you see here, go to the participant window. Okay, you're gonna see there is more. You can send me a thumbs up. I'm gonna show you my thumbs up. Go to the participant. If you click more, you can give me a thumbs up. Who's paying attention? Give me a thumbs up. Okay, let me see. See, they're not paying attention. I can't understand what you guys. Where's the thumbs up? Give me a thumbs up. Okay. All right. I see some folks, they do that, but some people, I don't know what they're doing. I don't know what they're doing. They're slipping. I don't know if they're slipping. I don't know what's going on, but we're gonna continue. Let's continue with this beautiful session, man. You gotta love it. See, when you go that exam, I do not care if you speak English or not. You just need to understand the word that come in your mouth, man. Once you understand the word that's coming, then you should be able to pass the exam, all right? Okay? Maybe I tell you they try to trick you. We're almost done with this session, okay? I got to keep track of the time. Okay, we're good. How? That's the next question. How are premium invested? So now, depend how they invest the premium, guys, you're going to know what kind of annuity you have in front of you. So there's two types of annuity. It's either is a fixed annuity or is a variable annuity they refer to as a VA. Okay? So if it is fixed annuity, how do you tell you what fixed mean? Fixed mean do not change. When something fixed, it do not change. So that's mean everything is guaranteed, everything is the same. So the interest rate is guaranteed to be fixed. So if it is 2%, 2%, that's it. It's not going to change. Invested into the general account. Anything fixed, go to the general account. That's when there is no separate account. It's level. Benefit payment amount. That's when the same amount you're going to get every month is going to be the same. It's not going to change neither because level means fixed. The risk, the insurance company take the risk. Because if the company say, I'm going to give you 2% and the market goes down by -2, they say I have to give you 2%. Guess what? That's why they take the risk. They still give you the money. So that's risky for the insurance company, is good for you. But at the same time, if the interest rate go way high, hey, it's bad for you too in that sense. Now, if fixed annuity do not keep up with inflation, so that's mean you don't have any inflation protection. If inflation goes up by 2%, It doesn't matter. Your money will not earn more than 2%. If it is the 2%, that's what they're gonna give you. 2%, that's it. They ain't gonna try to match the inflation so you can keep up with inflation. Because remember what inflation does? It makes price goes up. As in, the higher the inflation goes, more expensive stuff get. That's when you're gonna need more money. You're gonna need more money. So this type of things, annuities, they do not keep up with inflation. So that's why some people may not buy them, but some people like them because of the guarantee. So think about this when you go put your money into a savings account or a CD. That's what that is. Kind of like that. That's what that is. Okay. Now, a variable annuity, on the other hand, is the opposite a little bit. Now, this one say, listen, the premium invested in a separate account. That's when there is a different account. The separate account, that's where we're talking about the investment part. Because anything variable need 2 licenses, remember? I already explained that. 2 licenses, life and security. That's when you have to register with FINRA. Okay? You don't register with SEC, by the way. You register with FINRA. But SEC oversees everything. Now, interest rate is not guaranteed. Oh, that's what happened. So that's why some people don't like the variable. Because if I'm on fixed, if I got 3%, I know I got 3% every time. But if it is variable, that means sometimes they might give me nothing. I don't like that. So that's why some people don't take this type of investment. But at the same time, some people understand, hey, I can invest in things that can give me 9, 10%, or even 11%. So there's risk to that as well. Okay, that's when they accept it. Premium purchase, they call accumulation unit. They're like share of a separate account, just like you're buying shares of a separate account. Okay, which become a set number of annuity unit at annuitization. So the value of each unit fluctuates based on the investment, because those units fluctuate because it's just like a stock. The stock fluctuates, it goes up and down. That's what happened with this. I would explain you 2 licenses, life and then securities, and it's regulated by FINRA and SEC. Now listen to me. Remember when I was explaining the variable life insurance, but it was also registered, it was also regulated by FINRA and SEC, and also the insurance department. But why this variable annuity only regulated by FINRA and SEC is because annuities are not life insurance. Remember that? That's why. That's right. What about index annuity? Now, listen to me. There is some people, because those 2 products are available, they didn't like that. That's somebody like myself. I mean, not like the fixed annuity, but I might like the variable annuity, but there's some people that may not like the variable annuity. I might say, hey, I don't mind, give me all the variable annuity completely, because I'm young, I can invest the money if they were going to let me do that. Okay. But some people might say, listen, I don't want that. I want something where, can I get something that's guaranteed, but it can also give me something more? So they have a product for that. That's why there is another product that's a index. Remember I said, when you see the word index, always, when you see index, put S&P 5, put equal S&P 500. He attached to the S&P 500. It's mirror the S&P 500. If the S&P 500 perform great, this investment gonna do well. This annuity gonna do well. If the S&P 500 not doing well, because you have a guarantee, it's still gonna do okay, but it's not gonna do as much if S&P was always positive. So now index mean it's attached to an index. Usually they refer to the S&P 500. 500 is the 500 companies, Standard and Poor. That's what the S&P stands for, Standard and Poor. So now, index annuities, guys, also called equity index. Equity means stock. That's why the S&P is the 500 stock, the best 500 companies in the US. So fixed annuity invested on more aggressive basis for higher return. That's the reason somebody purchased that. They want to get a little bit more return. That's why they're looking for something like that. But even though they're looking for high return, but they still have a guaranteed minimum interest rate. So that's when they still get, like, let's say the company says, listen, even though this is, if index is fixed, but we're just gonna give you a guarantee minimum. So if they give you 3%, if the S&P give you 5%, so that you might end up getting more money into that account. But if the S&P negative for that year, but you also gonna get your guarantee, because I'm not gonna take no less than 2%. That's what they're saying. No less. More is good, less is no good. So that's what somebody will buy this, because they have a guarantee interest rate they're gonna get every single time. But if the S&P doing well, I get a chance to make more money. That's why this one, you just need your life license to do it. And then when you come in, you pass your exam, guys, you can be able to market a product like this to your clients. Okay, now this is less risky than variable annuity, but expected to earn higher interest rate than fixed annuity. So when you buy an index annuity, so this is where you can earn less money. Okay, on the fixed annuity, you earn less. In the index annuity, you can make more than the fixed. But in the variable annuity, you can earn more money, but it's not guaranteed you're going to. But you have a possibility to make way more money into a variable annuity. But also, the variable annuity is the only one that gives you protection against inflation. So let's say, which type of annuity that protect you against inflation? It's the VA, the variable annuity. Get that. That's the VA. Anything variable need 2 licenses. And I think that's it for annuities. Question. Woo! Ah, you made it. Ah, we made it too. Not bad. Any question, teammates? All right. So we did start at 7 o'clock. So this is about 2 hours. I'm gonna stop this recording.